Hey everybody, how you doing? Good deal. Thanks for coming out today. I'm Todd Dills, I'm the editor of Overdrive magazine, and today we're rebooting our Partners in Business program. It's great to be doing this again in person. It's been probably since 2019 since we had a session like this at a truck show, and we've been doing some of this virtually. We've been keeping the program up, but haven't been able to do it in person. So thanks for everybody for being in the room with us, and it's going to be a lot of fun. We've got a couple of presenters here today. Mike Hosted with ATBS, which is our partner on the Partners in Business program. And ATBS is a owner-operator business services firm. They have a lot of tax specialists, business consultants. I think you guys do the taxes for upward of how many owner-operators at this point?
Over 20,000.
Okay. So from that, they've got a lot of data that we're going to see here in Mike's presentation, and you're going to be seeing a lot of numbers, a lot of averages. Difficult to know quite what to do with those sometimes, but I think Gary's going to tee that up for us just in a second. Before we get there, though, I did want to note that the Partners in Business program is anchored by a book, which is Owner-Operator Business Manual. It covers everything from kind of just business startup to all the way toward expanding as a small fleet, planning for the retirement that inevitably we're all going to get to at some point, and everything in between. Gary once said to me, he sort of characterized this program as that old saying, I've got 99 problems, but X is not one of them. When a lot of people, a lot of company drivers get into business as an owner-operator, they don't really, they know everything there is, well, not everything, we learn something new every day, right? But they know a lot about driving. So they don't have a problem with driving, but it's those 99 other things that we all need help with, and that's what Partners in Business is all about. From taxes to planning to compliance and the ever-changing regulatory landscape and everything else. So Gary Buchs is Overdrive Extra contributor. He writes for us on a routine basis, a lot of different topics. He's a longtime owner-operator, retired from the road a couple of years early, just a couple of years ago, and has taken a more active role with Overdrive, as well as with a group of other owner-operators for whom he serves as business coach. And anyway, Gary, why don't you tee up this discussion for us, and we'll get right into it.
Is it on? Okay. Yeah, real quick. It's such a pleasure to be with Mike and ATBS and have them having the confidence to be part of their program. 99 other problems. We don't know what we don't know. And it's in constant motion, it's constant changing because of the environment, politics, life in general. And when we look forward to the changes in our life, we make those transitions from becoming a company driver to a lease or to an owner. So many dynamics change, and you have to change your mindset. You have to kind of retrain yourself and recognize that being a company driver does not train you to be a business owner. So we're going to talk about that. We're going to talk about the business side. We're going to talk about how to manage yourself. I'm going to hopefully talk a little bit about manage yourself as your own employee, because if you drive for yourself, you are your employee. And how are you going to manage that and pay yourself? Is your earnings just going to be your paycheck? How are you going to budget that? You need to have a plan. So we'll touch on some of those things as much as we can. So let's take it away, Mike.
All right, sounds good. Thanks, Gary. And thanks, everybody, for being here. Really appreciate it. As Todd said, I work for ATBS, American Truck Business Services. And so we are a back office for over 20,000 independent contractors. So we do all the fun stuff, bookkeeping, taxes, compliance, stuff like that. But really, our goal is we have business consultants there to help business owners like yourselves make good decisions and make them towards the business. A lot of people look at a paycheck and they determine that's what their business is. That's how they determine the success of their business. But that's not what it is. And so really, you know, our goal is to help our clients not only stay compliant with the IRS and all that fun stuff, but to help them become better business people. Because without our clients, we don't exist. So if we can make owner-operators more profitable, smarter about how they run their business, and things like that, then we're all going to be successful together. So it's really a partnership between us and our clients to drive success, to make sure you're making the most money you can and making the best decisions you can based on current circumstances. And you know, what I'll tell you right away is owner-operators are making the most money they've ever made. Rates are great, but the other thing you all know well is it's the hardest it's ever been to do it. Costs are through the roof, maintenance issues, fuel's going up like crazy. So it's been a tough time, you know. Rates are great for sure, but when hurdles happen, they're very hard to overcome right now. So we'll kind of talk about some ideas on what you need to be thinking about and all that stuff. I'm also going to get into some IC industry averages. So keep in mind these are averages. You know, there's a lot of folks doing a lot better. There's some folks that aren't very successful. So these are going to be averages right in the middle. But we're going to kind of get into the details of the data and kind of just show you what we're seeing and what the market's seeing. And hopefully, you know, you'll come away with, hey, you know, here's a couple things I can do to improve my business out of this. So we'll get into it. So the first thing we like to do is we like to talk about what is the economic environment of trucking right now. And we all know it's been a very good last almost 2 years now. Coming out of the pandemic, trucking is the best that it's ever been. And so we're going to look at a couple metrics that kind of prove that and talk through that to set the stage for what we want to get into. So first off, we'd like to talk about, you know, this is truckstop.com's index for freight. And so this is the spot market, a good view of what we're seeing in the spot market. Now, I know it's changed a lot in the last couple weeks, and we'll talk about that. But this just shows us the break-even over time. And so if you look on the left here, this is the ratio of the number of loads on truckstop.com per one truck looking for a load. And so what we're seeing, and this is as of February, we were seeing 183 loads per one truck looking for a load in the spot market, which is an unprecedented level. If you look through history here, generally speaking, we hovered around 20, 25. Things got really good in 2018. We were up to 70 loads per truck. Coming out of the pandemic, we've gone up over 200, and we've kind of leveled off at 183 with an average rate of $3 per mile in the spot market. So it's the best we've ever seen this. And generally speaking, when the spot market's this good, it only lasts 6, maybe 9 months. But we're going on almost 2 years and counting with very little end in sight. Now, I know over the last couple weeks, we have seen it drop. Right now, we're sitting at about 150 loads per one truck. And rates have gone down, what did you say, 10 cents, 20 cents?
It's so variable by region and so on. And so it's not a lot, and it's very individual. As the individual owner in your load selection is different. But on averages, I'd say from the numbers I'm seeing, 20 cents maybe. The point I'd like to make real quick is decision making gets harder sometimes when those numbers go up. You have to establish a new mindset, because when you're dealing with, if you look at your normal load selection when it's down here in your normal radius, you may be looking at 40, 50 loads, maybe 100 depending on where you're at. But when you get over here and you start looking at 500 load options, you have to have a mindset and a process you develop to sort that. You don't want to limit the data. You want to let your brain, so that's part of what you have to develop. And if you need help with that, that's the kind of thing that we help coach through. You know, there's not time today to go into the details, but keep that in mind. Lots more opportunity, but you have to learn how to manage that opportunity.
Thanks, Gary. Good point. So that was the spot market. That's what we're seeing in the spot market, people on their own authority, things like that. This is a different index. This is called the Cass Freight Index. So this is going to be through major shippers, major carriers, and things like that. So it's just a different view. That was the spot market. This is going to be contract rates. And so, you know, what we see here is in 2020, when the pandemic hit, this is the number of shipments. We went to an all-time low during the pandemic. And then coming out of the pandemic, we went to all-time highs in terms of number of shipments. And so this is just, again, kind of reiterating the fact that since the pandemic, freight's the best it's ever been, and it continues to be to this day. So that's shipments. Next is expenditures. Same index, but this is expenditures. And so again, coming out of the pandemic, you can see during the pandemic and in 2019, I'm sure you all remember 2019 was not a great year, but then coming out of the pandemic, we are seeing an all-time high in expenditures. And so what that means is rates to you all. Rates are the highest that they've ever been and continue to be, even with the recent drop. So this is just a combination of the two. And if you see here, shipments and expenditures, we're off the charts. And so really what we're illustrating here is not only in the spot market, but with major shippers and fleets and things like that, freight's the best it's ever been. So it's just a really good time to be an owner-operator and why we've seen a big migration, which we'll get at here in a second. So, myself and then the owners of ATBS, we've been out traveling to major motor carriers the last 4 or 5 weeks, talking to them about what they're seeing, indications of the market and things like that. And so this is just kind of some anecdotes about what we're hearing from major motor carriers, just so you can stay informed on what they're thinking too. And so freight is still very, very strong. It's the strongest it's ever been. Generally speaking, Q1 is a very tough time for freight, and we didn't see a slowdown hardly at all this year. So that just shows us the strength of the market right now. A lot of the fleets that pay by the mile, they had to increase their pay rates 2 or 3 times last year, and they're going to have to keep increasing them due to rates right now just to stay competitive and have any chance of bringing you all on. Every fleet has told us they would hire every single driver they could, but equipment shortages is actually the #1 hurdle right now in terms of being able to bring folks on and run freight for them. And then, last thing I'll say is they all said good drivers were pretty much impossible to find. At the beginning of 2021. It has gotten a little bit better, but equipment's still an issue. And so a good driver, how do you define a good driver?
2 thoughts come to mind here. How many here, just quick raise of a hand, you may have thought about hiring a driver or you're presently trying to hire a driver? Had been having any success? Anyone having success? Okay. Because you knew the individual or because you are close enough to the management, I'm going to guess that when you're smaller, you can't get more intimate. The other part is, and I asked Mike this earlier, we were preparing, let's define good drivers. When companies talk about what's a good driver?
A good driver is a safe driver, and a good driver is one that operates their business in the proper fashion.
Because if you are a lease operator or a company driver, if you're a lease operator, you're not profitable for that fleet, you're not going to stay in business or at that fleet. The best retention that a company has for lease operators is they want to increase your profit. You got to stop thinking gross dollars, because if you ask people, they all like to talk about gross. We all love to talk about gross, but we got to start thinking profit, pay and profit after we pay all the bills.
Yep, good call. So that's just, again, some anecdotes about what carriers are telling us right now. And again, it just sets the stage that it's a driver's market. There's money to be made out there, and fleets know it, you all know it. So it's just a good time to be an owner-operator right now. We also asked our partner carriers, the big carriers out there, how long do you think this market's going to stay good? And if you look at the 2 graphs on the right here, the majority of them think through the end of 2022, but even more think beyond the end of 2022. So these major fleets, they've got their hand on the pulse here, and they know what's going on. And the vast majority of them think it's going to be good through at least this year, probably well into next year. So really good news for everybody,
There's a lot of people that are really teetering on thinking there's going to be a collapse. When we say that, I think there are probably people in this audience go, man, I have trouble believing that. I feel like we're on the edge of the cliff or whatever. What will prevent that from happening probably, we talked earlier, shortage of equipment, shortage of drivers, shortage of good drivers, the ability to get repaired and so on. So capacity, older drivers are going to be retiring if the market starts dropping at a faster rate, I believe. So I think that, yes, there's going to be some shifts, there's always is, but I think the outlook is much better than a lot of people may think.
Yep, I agree, and kind of like he alluded to, generally speaking, when freight's this good, companies go out and they buy as many trucks as they can, they hire as many drivers as they can, and they flood the market with capacity. Well, they can't do any of that. So generally speaking, we shoot ourselves in the foot when things get good because we flood the market. Well, we can't do that now. Right. We don't have the ability to do it because we can't get trucks and we can't get good qualified drivers. So generally speaking, this is a really good thing of these shortages. It's going to keep us all profitable longer than it ever has in the past. So one thing we like to talk about is the driver career journey. You all are at different portions of this career journey. So, you know, the general path, you go to school, you do your training. The next step is you got to become a company driver, spend a year there, and then, you know, most people say, hey, I don't want to work for the man. I don't want to be told what to do anymore. So what's the next step? You become what we call a pioneer. That's a lease purchase driver. Hey, I'm going to get my feet wet. I'm going to try my hand at running a business, see how it goes. A little bit higher of a failure rate in that model. Some people aren't made for it. Sometimes it just doesn't work out. But there is a lot of success. And probably most of you in this room have been through that path and had success, and you move to the next step. We call it a hired gun. That's you had some success as a lease purchase. You decided, I want to go out and buy my own truck. But you like that safety net of running for a motor carrier. You get the discounted insurances, fuel, their freight network. They don't have to bill for loads and things like that. So you buy your own truck, you hook it onto a carrier. Next step would be, hey, I'm tired of running for a carrier. I see these $3, $4 spot market rates. I'm going to go get my own authority. So you have your own truck, you take it to the spot market, and you start playing in that and you know, running your business all on your own. And then lastly, you have success there, and you want to keep growing. You know, there's money to be made. We all want to grow right now. So you start your own fleet. You start bringing on trucks, bringing on drivers, and things like that. We were talking earlier, and Gary, what was you saying? What's the biggest hurdle probably to go from one truck to multiple trucks?
It's learning to manage people and not trucking. Because when you start hiring drivers, to deal with that interpersonal relationship is totally different. They call you up and say, you know, hey, I've got trouble at home, you know, the wife, the children's sick, or whatever. I want to go home for the musical my daughter's going to sing in, or, you know, and that's not in the interest of your fleet. You're going to be agitated and so on. They don't take care. As a small owner, we think we'll hire somebody and they'll operate like we do. They'll work as hard as we do. They don't have the sweat equity invested that we do. So you have to probably think in terms of, if you're running 100%, if you're lucky, they're going to run 80% of what you do. And you've got to pay for that and still return a profit. And that's one of the big hurdles. You know, as a hired gun, I did that because I hired the company. I didn't lease to somebody. I didn't work for somebody as an employee. I considered that lease. I was hiring them to do all the back office work, collection, safety, compliance, support that I needed. And they took that pressure. So I could focus on what I did best and hire the best to do the rest.
Yep, makes sense. Thanks, Gary. So yeah, just think about where you are in the career journey. It's always interesting, and you have to think a little bit differently depending on where you are. So next thing I'll say is we asked our partner fleets, did you grow in 2021? And I'll tell you right now, every single one of them tried everything they could to grow last year. Every fleet in the country spent as much money as they could on recruiting, finding drivers, whatever it may be to grow. Only about half of them ended up growing. The other half actually lost ground last year. We'll get into why here in a second, and I think you all know why. But I just found that very interesting. So for us, it's always interesting to figure out how many owner-operators are out there right now. And there's no, count that says, here's how many drivers or owner-operators, businesses there are. There's no way to just go find that out. So what we know is there's an estimated 3 million CDL holders in the U.S., which is amazing. That's just less than 1% of the population is a truck driver. And that's everything, though. That's over the road, final mile, people that drive dump trucks, you name it. Our best estimate in the past, based on a bunch of surveys and things we did with research, was about 10% are owner-operators, so about 300,000. And that was split up. About a third of them were in a lease purchase. About a third of them were in their own truck, but they pulled for a major motor carrier to have that safety net. And then about a third were out in the spot market on their own authority. Well, because of the nature of the market right now, we've seen a pretty big migration from folks going from company driver to owner-operator. And why wouldn't you? It's a great ability to have the freedom to go out and run your own loads and make your own decisions and still make a great profit at the same time. So the best current estimate is there's probably about 450,000 owner-operator businesses in the U.S. right now. And a migration has gone towards that person getting their own authority. So this is just a different look at the same thing. So this red line is the number of power units at major motor carriers. The blue line is the number of owner-operators. And so what this tells us is, again, people are getting into the owner-operator world, but they're not necessarily going to the major carriers. When they're becoming owner-operators, they're going and getting their own authority. They're going to a smaller fleet or pulling for their buddy or whatever it may be. So we're seeing a lot of people turn into owner-operators, but they're going out and doing their own thing and pulling for smaller fleets right now because of the market that we're in.
Mike, what are some other reasons that you think people are going that route and leaving the company to become that? Is it they think more money, they think more freedom?
Generally speaking, it's more money. They hear their buddies making $3 a mile and the carrier's only giving them, $1.80 a mile. And so there's a huge opportunity there. It does come with a lot more heartache though, which we'll get into in a second. But I'd say the major reason is the opportunity. It's amazing. It's the best it's ever been.
You give up that safety net, so you got to be ready to accept the risk that you have decided to take on. Remember, in business, not to discount the cost of risk.
Absolutely. So next thing we asked our fleets is how much do you want to grow this year in 2022? And I'll tell you, every single one of them, they want to grow more than 20%. They would tomorrow if they could. Every fleet out there would add as many trucks as they could, as many drivers as they could tomorrow. But because of the constraints we already mentioned, truck shortages, lack of good qualified drivers and things like that, their realistic expectation is, hey, even though the market's amazing and we'll do whatever we can to grow, the best we think we can do is 6 to 10%, which is very interesting. So next we asked, what are your obstacles? Why can't you grow? And so for the last 20 years, it's been driver shortage, driver shortage, driver shortage. We can't find drivers. Well, that is still an issue, clearly the number 2 issue, but all of a sudden trucks is actually the number 1 issue that's hindering growth right now, which we'll get into more in a second. You all know the truck issues. Any of you trying to grow right now, trying to price out a truck and buy one, it's painful. So we'll talk about that more in a second, but it's very interesting that all of a sudden driver shortage isn't the number 1 issue, it's trucks, which makes for a very difficult environment to grow in, especially for that small, person that's starting their fleet and trying to grow. It's a very difficult time and again, risky to grow. So next we're going to get into the analysis. This is the data. This is what we're seeing, what we're hearing, and things like that. So this is very straightforward. Again, keep in mind these are averages. So I know there's a lot of you that do better. Hopefully all of you do better than the average. And so what we're looking at here, and you don't have to read all this, basically what we're looking at is we're looking at 2021 versus 2020. What does it look like year over year? What are the changes? What have we seen? All right? And so first off, we're going to look at revenue, the engine that drives your business, the most important thing. We'll start off with miles. So the average IC was down almost 8% in terms of the number of miles they ran in 2021 versus 2020.
Who drove fewer miles? Did you plan to drive fewer miles, or did it just happen? Or was there a hardship that caused you to drive fewer miles? Planned it. Okay. How many tried to drive more miles? Did anyone drive more miles? Okay.
I think mostly because of COVID in 2020.
Okay. Okay. The rebound. Okay. Yeah, good point.
Yeah. So one thing I'll note here, 8,000 miles is what we're seeing less for the average owner-operator. We just said there's 400,000 owner-operators. If you do the math there, that's 3.2 billion miles that we lost in capacity last year. So not only do we not have enough trucks, not only do we not have enough good qualified drivers, but then we just lost 3.2 billion miles because people didn't want to run as much last year. They didn't have to because rates were so good. So all these factors have kept the market strong and will continue to for the foreseeable future. All right? And so this is a really interesting one. This is the average miles over time for an owner-operator. If you look on the left, we start this back in 2003. So some of you have been doing this since then. I know that's right when Gary started. We were talking earlier. Our average client was running
I started right here, and I wrote it up, and I finished the year, and I sat down, and I broke even my first year as an owner. And I told my wife, I need new plans. So it's going to be a short-lived experience.
So the crazy thing here is the average owner-operator in 2003 was running 139,000 miles a year. Think about that. That is a lot of miles. We just said our average owner-operator is running about 92,000. That's a big drop in miles. Now, there's been a lot.
That's part of what I did.
Yep.
I cut my miles by about 30%.
Yep.
and my profit went.
So there's a lot of things that impacted that. You know, hours of service, ELDs, you name it. You can't run 3 logbooks. It was great when you could. You can't anymore. So the interesting thing about this is, when you look here, 2008, this is when things were great in the world. Everything was as good as it could be, and then the Great Recession hit. Well, guess what? Drivers' rates went down. Drivers had to work harder, and they did. ICs work as hard as they need to get that revenue and to make sure their family's taken care of. And so you can see here the ups and downs of the economics of it. In 2018, freight was amazing. Miles fell off a cliff. 2019, 2020, we didn't know what was going to happen when COVID hit. The world was going crazy. Everybody was running hard, and things then got really good again, and we're falling off another cliff. So what this really tells us is people work as hard as they need to, and they're not going to overdo it. Why would you? Go home, spend time with your family, whatever it may be. But this just shows us during good economic times, miles always go down.
18 was the ELD effect.
Yep.
People, it lowered our miles, but our profits went up.
Yep. So it's just very interesting to see that. You'd think intuitively, hey, freight's the highest it's ever been. You should be out there making hay when the sun shines. But quality of life is just as important as money. We all know that, and this really reflects that, which is, a very good thing. So now revenue per mile. The big thing here I want to focus on, and we'll just be quick at this, but the average revenue per mile last year went up about 17%. About half of that came from fuel. Fuel surcharge going up, of course your revenue is going to go up accordingly. But the other half really came from pure rate increases. People are just getting better rates out there on the road, and it's just good to see these rates going up. So sure, fuel surcharge did impact it, but rates have gone up, and I know you all probably have felt that, and hopefully it's benefited you. So I really like this chart, and I'm gonna spend a little bit of time on it, but not too much. And the bottom line here is, this is our analysis. This is what it takes to run in the spot market versus pull for a motor carrier. We believe it costs about $52,000 more in revenue a year in order to go to the spot market versus run for a motor carrier, or about 50 cents more a mile you need to be grossing in order to make that switch and just break even. And so why? Because you have to get your own license, permits. You have additional insurance, and if any of you are on your own authority, the liability insurance to go out and get started is unbelievably expensive.
That's not total insurance. That's just additional insurance on top of what you're already paying.
Yep.
Make it real clear.
The next one is trailer, and so this is a big problem right now. Trailers are harder to find than trucks, and they're about 2 or 3 times what they should cost right now. And so that's what we tell our clients. When you're going out to get your own authority, go vet a trailer and see if you can find one first, because it doesn't do you any good to go through all this if you can't find a trailer. But realistically, that trailer cost is probably really low, and that's an annual cost, not a total cost. But I've seen used trailers for $70,000. I mean, it's outrageous right now. So, not only is it difficult, but it is hard and expensive to go get it. And then the big piece, I'll let you talk through.
This operational loss, the loss when you're broke down, what's it cost you an hour when you're sitting between loads if you can't drop and hook? But if you're down for 2 weeks, what's it going to cost you? How are you going to pay yourself? And so on. So that adds up in a bigger hurry than people realize, and often that's why they fail. But I want to help, and I just realized this when we reviewed earlier, I didn't catch it. These are all fixed costs. If you can't run, and you own all that stuff, your own authority, that's all fixed costs. That's not going away. If you don't move, you still got to pay the bill. Additional costs. Keep that in mind.
Yep. So I would say this is a minimum, probably a bare minimum. Generally speaking, it's probably you need about $40,000 up front to make that switch from a carrier, and then you need to make an additional $50,000 in revenue over that just to break even with all those different hurdles you have to face. So it's a really good number to know. Now, it's not set in stone, and you have to do your own math and work through it, but it's a good starting point, to say the least. And so next, we'll look at it. This is a tightened view. So this is since the beginning of 2020. Does it make sense to run in the spot market, or does it make sense to run for an average motor carrier? Now, I will tell you there's a lot of motor carriers that are far above average, sure. But this red line here shows us, hey, that's the break even. So when the pandemic was roaring, the spot market fell apart quickly. But coming out of the pandemic, and once that stopped, we have seen all-time highs in that. And so really the big picture here is That black line shows us, hey, if you're in the spot market right now, you can make about $120,000 more in revenue. And it only costs us $50,000 more to get there. So that net good is about $70,000 more you could make in the spot market versus the average motor carrier. I will also say this isn't for everybody. You know, billing for freight, collecting money, things like that is hard. So if you don't want to go through all that, you know, think about it. There are a lot of good carriers you can hook onto and do just as well, and this is a difficult way to do it, especially with the constraints right now.
I'd like to mention here, I talked about risk. The way I managed and I helped people learn part of the management of what freight you haul and select, contract, direct versus spot. You see all these high spots, you're like, man, I just can't afford to give that up. But a good strategy would have to be a balanced approach. Think about an investment portfolio. You want to have those things that are kind of foundations like we talked about, set in stone more. So you got those contract rates that are profitable. They're a little less profitable per mile, but then you can take advantage on some loads to fill in between with those spots. So you're not dedicated where you're locked in 100%, but you balance it out, just like an investment portfolio. So you have some higher risk with the spot, less risk, but both profitable.
Good point. So next thing I'll talk about is when we asked our fleets how they pay their drivers. They're independent contractors, and 60% of them now pay in a percentage model, 40% pay in a pay per mile model. I would say 2 years ago, this would have been flip-flopped. You all are smart, and you know if you're getting paid by the mile and rates are going up the way they are, that's not fair. You want to get that percentage base. You want to get that higher rate. So we've seen a mass switch with motor carriers going to the percentage model because they can't attract drivers or retain drivers if they have that pay per mile rate. And the mileage fleets, as I said, are increasing those rates on a consistent basis. Fast forward or rewind 5 years ago, and this was probably 80% paid mileage and 20% paid percent of revenue. But due to market conditions, fleets are switching because they need you all's help, and they want to make sure it's compensated fairly.
Keep in mind when you talk percentages and you hear these numbers all over the place, oh, this fleet plays 80%, 85%, some 90, some 65. Percent of what? And what services are you hiring or receiving for that percentage you're paid? You have to measure that. Everybody thinks company takes 30%, that boy, that's 30% profit. No. If you look into those companies, they have about a 4%, 3 to 4% profit in the revenue.
That's a good point. There's a lot of fleets that pay 65, 70% that their drivers make way more money than the ones you hear paying 88%. I mean, it's not even close.
Percent of what?
Yep, you got to really vet it out and understand what it is. That percent number does not matter. It's the bottom line and what happens at the end. So, great point. So next thing we asked is, do you plan on giving a pay increase this year if you're a pay per mile? Now keep in mind 60% were percent of revenue, so they don't care. They're not going to give a rate increase. That tells me the rest of them, the pay per mile fleets, are going to be giving rate increases this year. Next, when are you going to do it? And so again, that left bar, they're all percentage paying fleets. They don't care. They're not going to do it. That tells me that everybody that is a pay per mile fleet, they're going to give rate increases now, first and second quarter, because they got to continue to do that to keep up with the marketplace. All right? So again, keep in mind these are averages throughout this whole process. But the average I see grossed $162,000 last year, up about 8%. And you can kind of see on the right here, folks on their own authority, dry, reefer, flat. Either way, good percent increase in terms of total revenue. Again, some of that did come from fuel surcharge for sure, and it's going to continue to swing that way. But rates themselves were up pretty high. So that's kind of the picture on revenue. Let's talk about costs, because revenue's great, but controlling your costs is really where you can turn up your profit to new levels. So we'll talk about fixed costs and variable costs and kind of how they lay out here. But first thing I like to do is just kind of outline the big picture. And so fixed costs year over year, 2021 versus 2020, we're only up about 2% or $1,000. Not a huge increase, actually. The key here, though, and we're going to see this reflecting time and time again, is the cost per mile here on the right. We went from about 48 cents a mile to about 53 cents a mile in terms of fixed costs. So 5 cents a mile more just for those fixed costs. Next, variable costs. Now this one's fun. 17.3% year over year. Sure, some of that's fuel, but maintenance too. Maintenance has gone through the roof, and we'll get into that more. But again, if we look on the right here, we went from about 48 cents a mile to about 63 cents a mile. 15 cents a mile it costs for your variable costs more year over year. That is huge. And then when we sum it up, the average IC, it costs you $10,000 more to run your business in 2021 than it did versus 2020. And again, 20 cents a mile more to operate the average truck right now, year over year. That is a huge jump in terms of cost per mile. Huge, huge. So as I mentioned, things are great, but it is difficult and it's expensive, and you really have to be a good business owner to do this right. So just a very noteworthy thing. So
I'd like to add in here, think about fixed cost as time and materials here. You got your fixed cost. You don't run, you still got to pay it. You want to take 2 weeks off, you still got to pay that bill. You got to make that up somewhere. Yeah, you equate it back to miles in the end, that's fine, but that'll drive up the mile cost when you take that off. Variable costs are miles. Actually, variable costs are the easiest, because if you're not moving the truck, you're not paying it. So time, materials, fixed cost, fuel, tires, everything else when you move the truck.
definitely. So fuel costs year over year, 33% increase. And keep in mind, this is as of the end of December 2021. So next time we get together and do this, who knows where it's going to be. But that is a huge jump year over year, and we've gone way up since then. So we're going to spend some time on fuel here in a second. It's y'all's biggest cost by far, but it's also the one you can control the most. So this is really cool. We track our clients' fuel mileage over time. So we started back in 2003, and what I want to do is I want to zoom in here on the COVID times. And I know you all experienced this, and you all know this, but it's just really cool to see. So prior to COVID, 2019, fuel mileage averaging 6.5, a little over that maybe. And then the world shut down, and fuel mileage went through the roof. Why? Lack of congestion. You all probably remember it very well and are upset that it's not there anymore, but the lack of congestion, yes, exactly. The lack of congestion caused us to get the best fuel mileage we've ever had in trucking. It was amazing. And then coming out of it, winter months, of course, it goes down. We've got winter blend fuels, we've got increased idle time, things like that. And we've kind of leveled off again here at the end of 2021, where people are going back to work, commuting, sitting in traffic. I know it's worse for me now than it's ever been, and you all experience it way more than any of the rest of us. So very interesting to see. But the key note here is, fuel has gone up so much that we really have to start focusing on that again. Last year, fuel wasn't that bad, and we could just generate revenue. Well, now we can still generate revenue, but with the cost of fuel, we've got to find that balance. We've got to get that right fuel mileage versus the right revenue generation to be the most profitable we can be. So again, last year it was different. Now we have to start factoring fuel back into the equation again and really start focusing on it, because it's really high and it costs a lot of money to fill those tanks. So this just illustrates it again. Gold bar is 2020, the black bar is 2021. We lost fuel mileage downward in every single segment of trucking. So again, it's due to the congestion and also just people's general habits.
People are driving faster.
Yep.
Oh my gosh.
You see company trucks getting turned up like crazy because these carriers want to get those miles. They want to get the loads hauled, I think that's going to start to shift back the other way because of the current situation we're in.
Steve, does driving faster make you more money? Yeah. This is Steve Crone. He's averaging about 11 miles per gallon with a 2001 International. Okay.
All right. So what's next? Revenue versus fuel. We know we went up $11,500 in revenue, but it cost us $8,600 more in fuel to get there. So sure, revenue's up, but so are the costs, and we already talked about that. But it just kind of illustrates, hey, it's a big deal. It's going to continue to be more. And this is really busy. What I want you to focus on here is the average IC, even though they made $11,500 more in revenue, after that fuel takeout, they only profited about $3,000 more. That's tough. When things are so good, you know, you'd like to see that profit skyrocket, but it's really hard to get there, and you got to manage your business right. So,
And did that extra risk, was there risk involved with behavior and driving speeds and so on?
yep.
You know, that risk is a high cost. Don't
Yep.
forget that.
So what's going on in fuel, and we can argue about this, make it political, whatever you want to do. Bottom line is it's a commodity. Oil is a commodity, and it's all based on supply and demand. So why is it so high? There's a whole bunch of factors. First of all, we cut production when COVID happened. We didn't need fuel. We didn't need any of that stuff to happen because no one was driving. They were literally giving oil away. They couldn't give it away when that all happened. And so what did that do? That cut our production like crazy. We stopped doing exploration. We stopped production. We did a lot of things, and we haven't returned to that pre-COVID production level yet. So our supply is short. The Bureau of Labor and Statistics issues year-end inflation ratings, and oil and fuel were up 43.6%, the highest inflation rate of any commodity in the U.S. year over year. The loosening COVID restrictions have people traveling again. People are driving to work. People are flying for work. People are going on vacation. All this is causing a tighter push on fuel because more people are using oil to get to what they need to do. And then lastly, again, no politics in this, the crisis in Ukraine has caused fuel to skyrocket. We don't get much oil from Russia, but other countries do. And so when they cut that off, now they're grabbing from the same supply we do. So all these factors combined have caused fuel to just skyrocket at an unbelievable pace with all this happening at one time.
Remember, oil is a commodity traded on paper. Great influence upon what the prices are. Anybody here who's been involved in farming and so on, just like grains, livestock, and so on. So it's not wholly just to think about how much volume of oil. The paper influence of traders has a great effect on what you're going to end up paying for fuel.
Absolutely. So real quick, and you don't have to read the details on this, but the fuel surcharge, what is it? The fuel surcharge actually came about after Hurricane Katrina in 2005. And so all it is a mechanism to balance the fluctuation in cost of fuel. And I just put a very generic formula up here. Every shipper, every carrier, everybody has a little bit different calculation. So this isn't like, hey, this is how it works. It's very similar and generally very similar calculations. The big thing you need to know here is, what is the basis of what freight you're pulling? And so on this one, it's 6.5 miles per gallon. That's pretty common. That's generally what we see is about 6.5 miles per gallon. And so the bottom line is, as long as you're getting 6.5 miles per gallon or whatever your basis may be, you shouldn't ever spend more on fuel. The fuel surcharge is there to make sure that no matter what, as long as you're getting that fuel mileage or better, the cost of fuel shouldn't impact you whatsoever.
Is that current, or that's not current?
That 311.
Okay.
311 was when I pulled those calculations.
Give me a number for fuel surcharge. 62. I've heard numbers over $1 in some contracts. So it's very individual.
Yep. So yeah, again, keep in mind this is no master equation, but this is generally how it is. And what you really need to know is that basis. What is the basis that this is on? Is it 6 miles to the gallon? Is it 7? That's where you need to be. As long as you're there or better, you're actually going to be just fine, and fuel should not touch you whatsoever. The other thing I'll tell you is the best owner-operators will tell you time and time again they want fuel to go up. Because if fuel goes up, you can profit on fuel. Yep. So the more fuel goes up, the more money you stand to make, so long as you're running your business efficiently. All right? And so this is really busy. And what I did here, though, and what I want you to focus on is the column on the right here. And so this is based on that 6.5 miles to the gallon. If you're getting 6 miles to the gallon, you're losing money. 5 miles, you're losing a lot of money. But as long as you're getting over that basis, 6.5, so it's 7, 8, 9, 10, you're actually profiting off that fuel surcharge. And the higher that fuel surcharge goes, the higher your profit is. So again, the best operators are going to tell you, fuel going up is really good as long as you're getting good fuel mileage.
People have told me they can't afford to slow down to save fuel because they have to run more miles. These are owners. Got to get that extra load in. But they're not doing the math on what would be the profit if they slowed down versus driving faster and trying to haul another load. It's very individual, of course, but also is the risk worth, taking? You want to balance out and have that quality of life and so on, and you don't want to panic.
Yep. the bottom line is every load's different, every situation's different, and you need to have the tools and the foresight to do the math and figure out, hey, what makes sense for me? Is it more revenue? Is it less fuel? You got to have a combination of the two right now to be the most successful. So, driving habits, we won't spend too much time on this. You all know it. But slowing down is the biggest one you can do to impact your fuel mileage. I mean, that's all there is to it. Slow down. For every mile per hour you slow down, you're going to gain roughly 1/10 of a mile per gallon in fuel mileage. So if you're out running 75 and you're getting 6 miles to the gallon, if you slow it down to 65, you should get 7 miles to the gallon. It's basically that simple. You know, find the sweet spot. You know, what are the ideal RPMs for your engine, your truck? It's important to try to stay there. But really, you know, I think the biggest thing that we talked about is using that momentum. Don't waste your used fuel that you use to get up to speed with unnecessary braking. So stay back a little bit, you know. Yep. Don't be braking, because that is wasted fuel every second you brake.
Pressing the brake is like pushing the accelerator. And the other part is, watch your following distance so you don't have to brake. Leave a lot of room in front of you. Drive a little slower if you have to, and you will be more efficient. You'll still get there. Same time as the guy who sped past you almost. You've been up to the stoplight. You pulled up next to him. You know what I'm talking about, I think.
Yep.
So.
And everything else you all know. You know, use your cruise control when you can and when it's safe. You know, cut your out-of-route miles, and of course minimize idling when you can, when it's appropriate. So, you know, what else about fuel? Managing cash flow is probably the hardest part as fuel, especially as it goes up quickly. You all know that, but just be smart. Think about it every time you're fueling up. Does this make sense to fill up all the way right now? How's it going to impact my next settlement, my next check, whatever it may be? You know, if you got one more day before your pay period and you put $1,200 worth of fuel in, you just ate up all your profit. Sure, you're going to gain it back, but how does that impact you personally? You know, is it going to affect your bills and things like that? Just think about your cash flow when you're fueling with the price the way it is. Next, fuel discount networks. There's some amazing ones out there, and a lot of carriers pass those fuel discounts on to their drivers, their ICs. I know a lot of carriers giving 40 cents a mile fuel discounts, or 40 cents a gallon, I apologize, fuel discounts. So use those. You know, they're passing them on to you. You can ask questions. You can figure out if it's the right program, but generally speaking, major carriers do that. If you're not in a carrier, there's a lot of really good fuel cards out there giving huge discounts right now. So take advantage of them. Make sure you're getting everything you can out of this right now and using the tools available. A lot of them are free. So just go out there and get those discount networks and use them.
If you're not in a fleet, you got to do your own, get your own card. It's pretty easy to find one 20, 25 cents off. The other part is search for fuel prices. It may be that smaller station, not the big truck stop, where you can buy fuel often for 40, 50 cents lower on the pump.
Yep.
Than the big truck stop, because the big truck stops are pricing based in on that big discount they give the fleet of 70 to 90 cents. I mean,
And there's plenty of apps out there. I'm sure you
Yeah.
all use them. Plenty of apps out there. And if you don't have them, go get them right away. They'll help you.
Gas Buddy is a great one.
It is.
Oh my gosh, I use that when I drive all the time.
Yep. And then the last thing is optimizers. Fleets have spent millions and millions and millions of dollars to get these fuel optimization networks built for their company drivers so that they can save money. And most of the time, they give it to the owner-operators as a value-added tool. So, you know, I always hear drivers saying, you know, they're doing this to take money from me. They're not. They're giving you their best technology, generally speaking, to help you. And so they're going to help you find not only the best price, but they factor in things like fuel tax that are pretty complicated and hard to think about. And so those fuel optimizer networks, they're not just talking about the price, they're talking about the taxes and everything to get you to the lowest bottom line. So if you're not with a fleet, there's apps that do it too.
Fuel cost is really without your IFTA. Subtract your IFTA and compare it state to state, even within the state. That's what you want to know. There's a few states where it's a little bit different, but that many maybe. But
Yep.
generally, subtract the fuel, subtract the taxes, buy the cheapest
Yep.
fuel.
The other thing I'll tell you is we do a lot of research on this for our clients. So if you go to our website, atbs.com, and just search in the top fuel, there's like 50 articles, very recent, about fuel apps, about optimization, about how the fuel tax works state by state and things like that. So there's resources out there to help you really dig down into the weeds of this and make sure you really grasp it and are utilizing yourself the best way you can. So the bottom line is fuel's going up. We all know it. It's going up. It's gone up quickly. Seemed to have flattened off for a bit. We'll see what happens. But really what this means is you just have to adjust how you do business. As I said last year, you ran as fast as you could, generate as much revenue as you could, but you got to find that balance again. Rates are still at all-time highs. Even if we factor in the last couple week dip, we're still way above where we ever were before the COVID pandemic. So the spot market, even though it's dipped, it's still the best it's ever been prior to 2020. So things are still really, really, really good, even though it's dipped a little bit. But the bottom line here is if we look at a 100,000 mile example, at 6 miles to the gallon, you're going to spend 80,000 on fuel. And this is based on 485 fuel, so this might be a couple weeks old. Generally speaking, it's the concept we're looking at. If you go from 6 to 7 miles to the gallon, your cost went down $11,600 in fuel. And every dollar you save, you get to keep. So, for every dollar you generate in revenue, you got costs. You gotta give up 55 cents a mile to get that profit out of there. But every dollar you save, you get to keep. So if you go from 6 to 8 miles to the gallon, you save $20,000 in your pocket. That's like 3 months worth of work, 2-3 months worth of work. So efficiency is very important. Again, there is a balance, but this just illustrates, hey, that fuel mileage is more important than it's ever been.
How do you nudge yourself mentally to do this? Write those numbers down, 11,000, 20,000, 5,000. Then right next to it, what could you do at the end of the year with an extra $5,000? Would it be a nice vacation? Would it be the contribution to your Roth IRA or to your other investment portfolio? Could it be an improvement in home or business? What can you do with that asset? And write that down. That will give you the mental nudge to follow through. And don't just write it down and forget it, but writing it down makes it real.
That's right. Good point, Gary. So, just touch real quick on this. This is truck payments over time. Back when we started doing this in 2003, average truck payment was about $1,750. Through all the different regulations, clean air quality things, truck payments continue to go up over time. But if you look here in December, our average client's truck payment has gone up over $2,700, almost $2,800 a month right now. So truck payments are going to continue to go up just due to everything that's going on in the world, which we already talked about.
I want to touch on, because I got clients all the way from paying $1,000 plus a week lease to no payment. The young man paying $1,000 a week is the most profitable operator, and he'll probably clear profit-wise well over $100,000 this coming year. The reason is he has no maintenance. I mean, literally pennies for maintenance because of the way his lease is. So you want to look at the total cost of truck ownership operating, not just the truck payment. So don't just assume, oh, I can't afford that payment, or I'll be better off if I don't have a payment, because there are other factors involved.
Absolutely. So truck shortage, why is this happening? There's a lot of reasons, just like everything else in the world right now, but new truck orders are a year out. If you wanted to buy a brand new truck, you have at least a year before you're going to get that truck if you went and placed an order today. At least a year. There's no discounts for bulk orders right now, at least very little. And carriers are taking trucks that aren't even finished right now. So there's not enough chips, so they're like, hey, we don't need that lane departure technology. It's not necessary. So just give us the chip later. We need it. So that's how short trucks are right now. The chip shortage we all know about, and there doesn't seem to be a real end in sight to this chip shortage from what we can tell and people we talk to. It's a really big deal, and it's causing production delays and things like that. Plants shut down in 2020, so we have a backlog where plants shut down and weren't putting out new trucks. And then, as you all know, if you're trying to grow, used trucks are up 100% year over year, sometimes even higher. So, because of all this, because of the shortages, because of the lack of deliveries and things like that, fleets aren't selling off their old trucks that they had in the company fleet. They don't have the availability to. So all these factors have caused a big shortage of trucks and have caused prices to skyrocket and balloon and make it almost unaffordable. And, you really have to balance out, does it make sense to buy a truck at this inflated price? Can you pay it back quick enough before a market turns? And if not, you're underwater and you're in a bad place. So you have to do all the math and see how quickly you can pay it off. So maintenance, this one made me feel crazy when I saw it. How is maintenance flat year over year? It's because we ran 8,000 less miles. Plain as day. We ran 8,000 less miles, so maintenance total cost was flat. But if you look here on the right, The average IC, and again, this is an average, maintenance is a very customized deal, but the average IC went from 11 to 12 cents a mile. So 12 cents a mile is the average IC maintenance cost right now. That's a big number. It's a real big number, and some are even higher. That doesn't factor in opportunity cost either. It takes weeks to get through the shop and things like that now. So this is just a different look at the same thing over a long period of time. The key here is, again, the cost per mile continues to rise at a very rapid rate. And again, doesn't seem to be an end in sight for that right now. The other real fun one here, though, is when you see in 2009, there was a huge dip in maintenance. What happened? Why would that happen? And then a huge spike after. Things were so tough that people were deferring their maintenance. They weren't getting it done when they should have. And then that caused bigger problems, which caused maintenance to balloon afterwards. So stay on top of it, because ballooning this now would be a death wish.
Could we have the same result, but because of a different reason with shortage of parts coming? Could we have that bounce when we come out and we start getting more parts and people need to repair these trucks they couldn't repair, even though they have the money now? We could see that people need in-frame trucks, for example, because they kept them longer.
Yep.
Just an example.
We definitely could.
Yeah.
It'll be interesting times, but what we'll talk about next, what are the top 3 reasons for IC failure? Number 1 is maintenance. Every single time, at every carrier, at every personal owner authority, maintenance is the number 1 cause for business failure for owner-operators. 2 is health or retirement, and then 3 is not managing your finances and taxes well. So maintenance is the number 1 cause of IC failure. And what I'll tell you, what's going on, there's a lack of qualified mechanics. We all know that. You see crazy amounts of money being thrown out to hire mechanics, and they just can't seem to get them in. Shop rates are over $200 now, on average. A couple years ago, it was $125 an hour. So not only are the rates going up, but we're seeing fees like computer fees and just random stuff. It's like you're on Ticketmaster and feel like you're getting screwed again, So rates are through the roof. And part shortages, we all know. So now we've got a big lack of qualified mechanics, so it's taking forever to get in the shop. Then rates are through the roof, and then you get in the shop and come to find out they don't have the part you need. So then you're waiting again. And then all this is contributing to older trucks and longer than normal lines, which is just compounding these issues over and over and over again. So all these things are a really big issue, but the biggest issue is, in terms of failure, is ICs can generally afford that cost of the repair. They can afford that. They've generally set aside the money. They can't afford the opportunity cost, the 3 weeks downtime where they're not making any money, they're not paying their bills, whatever it may be. So the biggest cause of failure is maintenance, not necessarily because of the repair itself, but because of the lack of income coming in while you're waiting to get this repair done.
I'd like to touch on this a second and start thinking more about preventive maintenance, doing those things before they break. And that will eliminate a lot of these problems and reduce your cost. 17 years on the same truck, I was towed 1 time in 17 years, 1.35 million miles. Find a home shop that you trust with your equipment. Go in, talk to them, let them get to know it. A lot of people say, I got to do all the little things. Go in, have them do more inspections, have them do the little things for you so they know your equipment. In the long run, short term, you may think you're paying more. In the long run, there's a very good chance you will save a lot of money.
Absolutely. So, have a customized plan, not only to cover the repairs of your truck, but to cover that downtime, because that's the biggest pain point. So make sure you're setting aside money. Things are good, set extra. I'm being told we got to speed up here, so.
When you do what I talked about, you can schedule that downtime when you're taking time off. They can do those things when you have scheduled downtime.
Yep. Last thing I'll say on that real quick is there's some great fluid analysis out there where you can get your oil tested, your transmission fluid tested, things like that. They look for wear metals within that oil, and you just send a little sample of oil off. They'll say, here's the wear metals, here's what it means, and you can actually figure out, hey, this part is wearing out quickly, and you can get that part ordered, and you can get it put in while you're on home time. Now you've not lost that opportunity cost, and you haven't had that big repair bill waiting in line. So, quick, we got to go. We're running out of time, but net income was up only $3,000 for our average client, or 5%. About $71,000 is what our average IC made. So we thought that was going to be much higher, but again, business has become very hard to do. So it's just the nature of the business.
And
So
that 71,000 is Schedule C income, not a W-2 paying the employee.
Correct.
It's like your driver pay.
yep,
So in the future, you need to start thinking about, what am I gonna pay myself as a driver, and what's the return to my company?
so big highlight here, net income per mile continues to go through the roof. We're at about 75 cents a mile for the average IC, many making much more. Cool slide here though, our drivers used to run 140,000 miles a year to make 47,000. We're now at 95,000 a year to make 71,000. And again, many are doing less miles and making more money. I'm sure most of you are. So ending it off here, the average IC made 72,000 last year. Top 10% of our clients made over 225,000 take home. So there's a lot of money to be made. And you know, the FMCSA granted 110 new operating authorities, 110,000 new operating authorities last year. So the American dream's alive. There's money to be made in trucking right now, and there will be for the foreseeable future. So keep doing what you're doing. Think efficiently, run hard, and you know, make hay while the sun's shining, because it's shining still, and now's the time to make money. It's not going to be like this forever. So.
I wish we could cover more. We kind of skimmed over healthcare and some of those things. Had a brother, he's 4 years younger than me, had open heart surgery, $200,000 bill. Thank God they had insurance. I have met so many drivers, owner-operators that I can't afford health insurance, and it put them out of business instantly when something happened.
Awesome. Well, thank you, everybody. Appreciate your time.
And I just wanted to say, I skipped over a little bit about the Partners in Business book at the beginning, but there was a download URL on the screen. It's easy to find. Just go to overdriveonline.com/PIB. It's free download. Check it out. I hope you get something out of it. We're not going to have time for questions, so one of the things that Gary and I were going to do after this, however, is invite any of you here. If you want to sit down and have continue the business discussion, ask us any questions out in the hall. We
may have a room. I've got a
Yeah,
message.
I'll also be out in the hall
gonna-
if anybody has questions.
Yeah, we're going to
So-
find a meeting room and have a further discussion if you're game for that. So just talk to us after and join us later. But thanks for everybody for coming.